This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jonathan Farrow and Lisa Abramowitz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. John Farrow with Mary Barra.
I want to go through some of the numbers for our audience. Dividend up 33%, biggest ever buyback plan, $10 billion, $40 billion name yesterday, just for some context, perspective there. That is massive. Inquiring minds, Mary, will want to know, why have you decided to deliver a $10 billion buyback shortly after you've signed a Labour contract that adds $9.3 billion to expenses over its term?
Well, as we looked at what was happening from a labor perspective, we had built, and really the labor environment going into our negotiations, we had put conservative estimates into our plan. So although it was a little higher than what we expected, we believe that we have, and our guidance for next year we've already said that we'll be able to offset that completely with the plan that we already had of a $2 billion cost out perspective. So we did the right thing to recognize our manufacturing team members who have done a great job and continue to build vehicles safely with high quality. And we also thought that we've got to look and make sure that we're balanced across all of our stakeholders, and our owners are very important. So we think this was a very balanced response when we look at what was done from a labor perspective and what we're doing as part of our capital allocation framework for our owners.
Well, let's get into that. So shareholders are super happy. The name is up by almost 11% so far this morning. I wonder if UAW is. Mary, they didn't get the 40% they wanted. They got 25 plus cost of living adjustments and other things as well. Is the optics of this morning not something that concerns you?
When I look at it, I think it's balanced. Again, we have very well compensated, and when you look at the suite of benefits that our represented team members have, it's a very appropriate package, and frankly, leading from an industry perspective broader than just the auto industry. So I think we did the right thing to recognize and reward the hard work of our manufacturing team members across the board. But also, one of the things our manufacturing team members very much value is job security. And to have job security, you have to have a strong company, and you have to look at all of your stakeholders. So what we did from a share buyback perspective for our owners is, I think, a very balanced response.
As you know, this move this morning, not just about the capital return program, also about cost cuts. We know you're looking to fully offset that Labour contract, the additional costs from it. Have you identified where you will cut, where you need to cut?
Yes, a lot of this was already underway. At the beginning of this year, calendar year 2023, we announced a $2 billion cost reduction, structural cost reduction between 23 and the end of 24. That's well underway. As I said, we also comprehended that we would have increases in our labor cost as we looked at what the environment was, and also wanting to reward our manufacturing employees. So, there's work going across many aspects of the business, and including making our products more efficient while still having the features, the functionality, and beautiful designs that our customers want. So there's been a concentrated effort at the company to lower our fixed costs while enabling wonderful products and rewarding the team that is helping us deliver them.
Clearly, these are additional costs. Are they forcing a change in execution or a change in strategy?
Definitely not a change in strategy. Our strategy is clear. It's really based on 4 pillars of executing our strong internal combustion engine program vehicles, and we're performing very well in the market, and we see that we're below the average incentives. I think that speaks to the strength of our internal combustion engine products. From an EV perspective, we have confidence in the portfolio we have. We're a bit disappointed this year that we were constrained by the automation to build modules. So this is not something that is fundamentally an issue with Ultium. It was more a manufacturing automation issue that we're working, and we'll be out of it by middle of next year and making improvement every quarter from that perspective. Also software. And this year, earlier this year, Mike Abbott joined our team, who brings tremendous software expertise, and he's built a very strong team that we'll share more about when we get to our Investor Day in March of next year. And then autonomy. And when you look at autonomous vehicles and the importance of this technology and the talent that we have at Cruise, we are doing an independent review from an incident perspective, but also overall from a safety perspective, and that will guide our path forward there. But we have a very capable team there. So the 4 pillars of our strategy have not changed at all. What has changed is our tactics, and our tactics are changing because the world is changing. We never thought that the EV adoption would necessarily be a straight line. We've seen this in other markets. We're seeing it now in the U.S. But I think the thing that everybody has to remember, if the growth is slowing, it is still growing. And we think as we get more of the EV products we have this year into next, we think we're going to see a strong adoption for our products. And as the charging infrastructure continues to be more robust, we think that's going to drive adoption as well as having affordable EVs. And that's where, when you look at the Chevrolet Equinox as well as the Blazer and the Bolt that's coming, we're going to be having products in that range of affordable vehicles that is going to be very important from EV adoption.
Two things to unpack there. One is robo-taxis, the other is EVs. Let's deal with robo-taxis first. You're cutting expenses on Cruise substantially. Just how committed are you there? I remember only a number of years ago we were talking about bringing in $50 billion in revenue by 2030. And I get it, Mary. We all understand that new tech is tough to develop. It's hard to deploy. I think we're seeing that across a range of issues. But when do you know if it's the right time just to walk away from this?
Well, I think first of all, when you look at the progress that the Cruise team has made over the last 8 years when General Motors acquired Cruise, I think it's substantial. And we've already demonstrated that the Cruise vehicle can perform at a level that's safer than a human driver. Let's not forget, over 40,000 people on average lose their lives in traffic accidents in the U.S. alone, and 90% of them are caused by human error. What we have learned with this incident is it's got to be significantly better than a human driver to drive adoption, and we have to do a much better job of working with the regulators. That's something that GM has a long reputation of working and being transparent with regulators at the local, state, and federal level. So I think as we do that and get the results of the independent review we're doing, that will guide us on our path forward from a AV perspective.
I'm always interested in how we know when we're wrong, an exercise I think everyone has to go through, including myself, Mary. But on this topic of EVs, the slowdown, what's behind it? And why aren't we just learning that American consumers just don't want these cars?
Well, I don't think it's that American consumers just don't want these cars. I think there still is limited availability when you look at the choice that customers have today from an internal combustion vehicle perspective. I think a lot of the EVs that are out right now are more expensive. You've got to look at where the sweet spot of the market is. And when you really want to win in EVs, you've got to make sure that you are meeting the customer who only owns one vehicle. That's the bulk of people who buy vehicles today, new vehicles. They only own one vehicle, or if they have two in their family, they're needed every day to earning their livelihoods. So we've got to get affordable. There's got to be a robust charging infrastructure. So again, the growth hasn't gone in reverse. It's slowing. I think we never expected. We thought it would have some bumps along the way. I think that's what we're seeing right now. But I think when we have EVs that are affordable, when people realize how much fun they are to drive and the performance, and they're not giving anything up, and then that all-important charging infrastructure, I think we're going to see them start to grow at a more rapid rate again. And that's something that we'll continue to watch, and that's why we've changed some of our tactics to be responsive to where the customer is. You've been super generous with your time, Mary. I just want to fit in one further question. Right now, you're a $43 billion name. It's a big move this morning by 10%. The forward multiple, we're talking about 4 times expected earnings, a little more than that after today's move. The stock has been dead money for the best part of a decade. You've been doing this a long time. I know you're super close with investors. What is it that you think is in this plan, this strategy that you have, and a strategy that you've suggested this morning hasn't changed, that's going to turn this around? Well, I think demonstrating our commitment to all of our stakeholders, and I think when you look at a $10 billion accelerated buyback program, it should signal, because it means we have confidence in the cash generation ability of this company. We have confidence in our strategy across the 4 pillars that I covered. Yes, we had some challenges this year with our Ultium-based EVs that I think gave investors some concern, but we're demonstrating the confidence that we and the board have that we're executing the strategy, and we're going to see growth, strong cash flow, and strong margins. That's what we're going to deliver. That's captured in today's move, up 9%. Mary, appreciate your time. Really do. Thanks for catching up with us. Mary Barra there of GM.
Terry Weissman joins us right now, global FX interest rate strategist, much more than that at Macquarie, with lots and lots of experience on this. I love the first sentence of your note, don't believe the hype. You've been skeptical. Are you combining and dovetailing in with your low rate call a true slowdown in the economy?
Yes, absolutely. I think the The narrative these days from Wall Street that I've seen in the last few weeks is that the reason the 10-year yield has been coming down is because we're in a disinflationary phase here in the economy, and there's going to be more disinflation to come in the U.S. I agree with that. We are going to see disinflation in the U.S. It's going to come in rents. It's going to come in those areas of the CPI that are linked to consumer discretionary spending. But let's also keep in mind, one of the reasons we're going to see this disinflation is because the consumer is slowing. And there you have the don't believe the hype story, right? I don't believe the stories about record-breaking Black Friday sales and Cyber Monday sales.
Starts Wednesday, Thursday, whatever.
I think these sales were on the back of heavy discounting. If you look at what some of these corporate execs had said prior to the start of the holiday spending season, they talked about having to cut prices. Walmart even talked about deflation. So this is about disinflation, but let's keep in mind where this disinflation is going to come from. It's going to come from a weakening in pricing power at the consumer product and services level. It's going to be driven by a slowdown in aggregate demand in the U.S.
Also about how they're paying for this stuff. Buy now, pay later. You look at some of the numbers just booming. What do you take away from that?
So
Terry?
My takeaway is from a macroeconomic perspective, what it does is it shifts spending to the early part of the season, because normally you would have to save up a few more shekels as you approach, your deadline on December 25th to get those purchases done. With buy now, pay later, you don't need to do that. So it allows you to spend earlier, especially if you don't have access to revolving credit or credit cards. So I think that's another reason why we might have seen these so-called record-breaking days on last Friday and Monday. But again, if it's the case that spending was only pulled forward, it doesn't mean that in aggregate for the whole of the season we're going to get that much hype.
So far, people have viewed weaker U.S. data as a positive. It's both been for a bond rally and a stock rally, and you're saying that we could see that bond rally continue quite significantly going forward. Will there be a divergence, though, in terms of risk assets? Does there have to be to fuel a bond rally that goes much deeper than where we are now?
Absolutely. To let the bond rally extend to, say, where the 10-year yield gets to 3%, I do think it has to be associated with a sell-off at risk assets. I don't think to get that kind of forceful move early in the bond market, you need to have some sort of dislocation in risk assets, some sort of drop in stocks. But over time, not necessarily. I think we can see a situation where if disinflation continues slowly, you get the bond yield going down to where it was, let's say, in the spring. 3.5% is not inconceivable without a stock market drop, as long as it happens slowly and steadily.
But will corporations adapt? If I go back to Bear Stearns, where you held court, you had an entire security analysis team looking at these slowdowns. I don't buy the gloom in that corporations like General Motors will adapt.
I'm not sure what they're going to adapt to. Technological progress and changes they can adapt to. Government policies that spur more investment in electric vehicles and clean energy technologies, they can adapt to. But what do you do when you have excess inventory, as the auto dealers do now? What do you do when the banks and the finance companies are cutting off credit to auto buyers? What do you do then? You're not in control of that situation. You're in control of what's happening on your factory floor. You're in control of promotions, and maybe the way you adapt is by cutting prices. Let's face it. That's a way of adapting too, to hold on to market share in the face of excess inventories, in the face of consumers slowing their demand. So yeah, they can adapt, but it's not necessarily in a way that is going to make their stock prices shoot up.
You've identified a series of places in this economy where we could see lower prices. Retail, Walmart. Talked about the automakers, we're talking about GM, maybe lower prices. Going to see that come through the pipeline soon. What's the biggest threat that still lingers for you? The biggest threat to that view that this disinflation continues through next year?
It's supply shocks. I think the lesson of 2022 and early 2023 was that we cannot control what happens in the rest of the world, especially as it pertains to the supply of oil, the supply of natural gas. So from my perspective, if we get another shock in that market, and by the way, it doesn't have to be because of a war, although in the past 2 years that has been the case. It could be simply that OPEC Plus decides to curtail supply, and we get a Brent going back up to the low 90s as a result of that. Again, it's a question of how much they curtail supply by, but that's the biggest risk right now. The good news is that gasoline prices in the U.S. have been falling for 6 weeks straight, I think, and steadily. I think that's going to show up in the CPI by the time we roll around to seeing the November numbers and the December numbers. But the real reason that the CPI is going to still see disinflation is because rents in the new tenant market and the new lease market are coming down. That's going to put a lot of pressure ultimately on the BLS's measures of rents of primary residences. We're going to get that disinflation over the next few months.
This is exactly what Neil Datta of Renaissance Macro is talking about, Tom. The disinflation that's in the pipeline for rents, for used cars, which is why, based on what Wallace said yesterday, it's not that much of an if for the likes of Terry, for the likes of Neil Datta, which is why they think you're going to get this conversation early next year about reducing interest rates.
Yeah, there's no question there's a school of thought out there that this is not if, it's just simply when and the path to it. But I would dovetail it back to the labor economy, which we've barely touched on today. And we've got claims coming up here Thursday. And then you mentioned the late jobs report for November. I believe it's December 8th. But the basic idea here, John, is when does the labor economy finally go? If you get a labor economy to go, you get there instantly.
Claims 209. Keep going back to 209.
Claims 280.
We've been surprised by this economy in so many different ways over the last 18 months or so. Terry, it's good to see you. Terry Wiseman there of Macquarie.
Long ago and far away, there was KKR, 1976, with history made in a style and a method at KKR that was original. Shonali Bassett gets an update from their co-CEO. Shonali, good morning.
Thank you, Tom. I'm standing by with the co-CEO of KKR, Scott Nuttall, and it is a really big day for KKR because they are doing this. They are buying the rest of Global Atlantic, a big insurance company that they don't already own. That is an all-cash $2.7 billion deal. But you're also creating a new unit at KKR that houses a core private equity business.
Right.
If you had to give the market one way to understand what you're trying to do over there, what is it?
First of all, Shonali, great to be with you. Thanks for having me. Really what we're trying to do today is lay out the big three growth engines we have as a firm. So you're right, we are buying the minority stake in Global Atlantic we don't already own. We already own 63% of the company, so we're buying the other 37%. Global Atlantic has been a great partnership for us. This is a transaction we did in 2021. The company's more than doubled since we announced the original deal in July of 2020. And it's been highly recurring, a lot of growth earnings for KKR. So that's part one. We are also modifying our compensation ratios. So our asset management business continues to scale. Our run rate management fees have doubled over the last 3 years. So the second thing we're doing is reducing the compensation ratio on fees, making an offsetting increase on carry, and that will allow us to create more fee-related earnings for our shareholders.
You're changing the way you pay people.
In effect, not the aggregate amount of compensation, but we're providing more of the fee-related earnings to our shareholders, a little bit more carry to our people. The net of that is about neutral, but it will mean more fee-related earnings overall. And then the third thing we're doing, to your point, and this is relatively new for us, is we're creating a new segment for the firm. So we've historically reported as asset management and insurance. We are adding a new segment called strategic holdings. And what we will include in there are the dividends that we're receiving and will begin to receive in greater magnitude from our core private equity portfolio, which is a portfolio of great, diversified, recession-resistant companies that we've been building up over the last several years.
KKR, Apollo, Brookfield, they're all buying insurance companies. All of you are diversifying in pretty meaningful ways. If you think about it, it's made private equity by the dollars, by the assets under management, a smaller part of all of your businesses. What does this mean for the future of private equity?
Private equity is still a growth business for us. We expect to continue to grow that part of KKR for a long time, both with respect to the flagship strategies, but also we've created a number of different growth strategies. The core private equity business is part of private equity. It's now a $30 billion franchise for us. So this isn't about an or, this is about an and. We see an ability to grow PE and all the other parts of KKR. And we've diversified meaningfully over the course of the last 10 to 15 years. We're just continuing our way down that path.
Now, what does Global Atlantic exactly do? It seems like what it's really doing is giving you a whole balance sheet to be using to compete on. You've mentioned capital markets is one place. There's been a lot of competition from your industry to the banks. How does this help you now compete in a bigger way?
Sure. Global Atlantic, as you know, it largely issues annuities to individuals. And so if you think about what we do at KKR, we work for pensioners, retirees all around the world, now family offices and individual investors as well. Global Atlantic distributes its products to that same kind of an audience. So historically, we've worked for tens of millions of retirees. We still do, but now they're just in the form of policyholders. And that's our mission at KKR, is to actually do a great job for all those people that we work for. We're not confused about who our bosses are. And so to the second part of your question on capital markets, what Global Atlantic allows us to do is create more synergy. We didn't necessarily see all this 3 years ago when we started our way down this path, but we think there's even more we can do to unlock value between the two companies, and capital markets is just one of those examples.
Capital markets means you might be appearing on more and more deals, lending a balance sheet to provide capital for big buyouts and other leverage loan deals.
That's right, and we're already in that business. So the way that we built our capital markets business is by partnering with the street. So we'll be alongside the traditional banks and investment banks as we built that business. But what Global Atlantic brings us is an ability to expand the vision for that franchise. So there's more to do across asset-based finance, as an example. Or when Global Atlantic does their large institutional block transactions, we can put some on the Global Atlantic balance sheet. GA has its own sidecar third-party capital funds called Ivy, so some can go into those third-party funds, and then we can syndicate the excess through our capital markets franchise as well. Just like we do private equity and infrastructure transactions, it applies to insurance deals as well.
Something interesting about these deals is that you already have told investors this morning that this will add 20% to total operating earnings. You're boosting your targets into 2026 for fee-related earnings. What are the real financial impacts? What can stockholders feel for KKR over the next 2-3 years?
Well, I think what they'll be able to see is we are going to grow all three of our recurring forms of earnings in a much more meaningful way going forward. So fee-related earnings will be higher. We continue to see a lot of organic growth in our businesses. Just by changing our compensation ratios, you get accretion on fee-related earnings. And we think by virtue of what we're announcing today, we can do even more with Global Atlantic, where we invest that portfolio. It's already gone from $72 billion of AUM when we announced the transaction to $158 billion over the last few years. We think we can do even more together. But they'll also see more insurance operating earnings, which we believe are highly recurring and fast growing. And then we'll have this third element, which will be the core private equity dividends showing up in the strategic holdings segment. If you put those three things together, we think that'll be 70% or more of our overall pre-tax income is those three forms of recurring earnings. And we're going to introduce a new metric around that called operating earnings. And we'll talk about that later today with our shareholders.
Scott, we do have to leave it there. Thank you for joining us on a big day over at KKR. Tom?
Sonali Basak, thank you so much. With the gentleman from KKR and the future of what they do. Joining us now, Laura Rahm, Chief U.S. Economist at FS Investments, on an 8.9% nominal GDP America. Laura, what's so great about your economics is you've got it from the litmus paper of the FX market. How alone is the United States with an 8.9% nominal GDP when Rishi Sunak is telling Francine Lacroix he's worried about austerity?
I think we are still, the growth continues to just surprise to the upside. And to me, it's remarkable the inconsistency between talking about rate cuts to, this idea that we're going to need rate cuts in the near term to support the economy, or this short-term idea that we've seen the labor market slow, when really we do feel like we're an economy, and the data would show that we're an economy firing on all cylinders. Government, business spending, consumption. The only piece that's not really adding to it is residential construction. I would say that we are the standalone leader on growth.
And what's so important here, Lisa, nominal GDP top line, that's real GDP plus inflation, is there's an assumption here by the Bill Ackmans of the world, economists and not, that it's going to plunge down to what, 6%, 5%. Even that's a boom economy.
And when you say it, they're talking the inflation component. And Laura, that's what I want you to weigh in on. How much does it matter if we see a slowdown? Do we need a slowdown if we continue to see the pace of disinflation that we've seen so far this year?
I think there's two pieces to that argument. To me, the real, and one place where I'm probably off consensus, is I am really reticent to think that we are going to get this magical slowdown in inflation back to that 2% lane that we have had. On the good side, we have a lot of indications that just from some slower demand and from some of these resolutions in inventory that we're going to see lower goods prices. But I think we are really ignoring the big elephant in the room, which is services. We still have a hot labor market by my measure. We still have wage pressure that is way higher than prior to the pandemic. And the resting heart rate of inflation is still well above 2%. And on the services side really is the problem here. So I think we need to be careful about being very complacent about inflation coming down. And that really feeds into this non-recessionary rate decline, Goldilocks complacency that has taken hold of equity markets at this moment.
In some ways, the Fed's Waller really kind of fed into that yesterday, which is the reason why maybe he gave steam to some of these market movements. He said there is just no reason to say you would keep rates really high and inflation is back at target. How high is the threshold then to cut rates? If we do see the disinflation in the pipeline significant, it might not be long lasting because of some of these other issues, but we do see year-over-year comps come in with auto price disinflation or outright deflation, with rents coming in, with the fact that goods, as Walmart said, just prices are actually going down outright.
I think the Fed is good at looking around the corner on especially this rent issue. There's no doubt that rent is a very lagging indicator, but it's sticky for a reason. And all of the short-term indicators that 6 months ago were really pointing to rents coming down fast have now reversed. And I think something that's very important to me is the fact that rents are far below the cost that it is to buy a home per square foot. It's costing you a lot less to rent. And landlords are rational. They're going to see this, and they are going to, over the next several quarters, push rents higher again. So it's something that you just can't ignore in the core, even if you get the headline hitting 2%. I get nervous when the Fed tries to micromanage the inflation process.
Laura, in this, with your overarching philosophy of summing all this together, are we beyond the pandemic? It sure doesn't feel like it to me. It feels like the stimulus is still popping. But from where you sit, are we beyond COVID?
Not in the data, Tom. I think we're seeing this trampoline effect, and the Q3 GDP numbers are a great example of that. And we had a big inventory, push higher. We could very well get that still detracting from the fourth quarter. You're still getting some of these big swings in factors that are disguising what's going on underneath with demand, which is still really red hot. So this is a big, to me, piece that we're looking at for 2024. We start to see some move away from reliance on savings towards income. I think the irony is it could be a period of lower growth next year, but actually better sentiment about household economics as you see income finally catch up to the prior year and a half of inflation.
Okay, I'm going to pin you down here. Give me some 2024 Laura outlook numbers. Real GDP, what do you think?
Real GDP 1.4. And I think the 10-year stays pretty high. I'm putting it at 4% for 2024.
I mean, Lisa, these are huge slowdown numbers. And then the question comes over immediately, what does non-farm payrolls do? David Kelly at JP Morgan would say it goes negative.
Well, and this is really the ultimate question, Laura. Do we get that kind of slow growth but high yield along with a fully employed America, along with job creation that continues to chug along?
I think that we look at the recessions that we've had in the 2000s, 2010s, even the 1990s. We saw very little, if you look at 1990, 2000 recessions, we saw very little drop in output, but a massive decline in labor. In this, I think, upcoming year, we're going to see a slower economy, but I think that companies continue to view labor as a scarce resource. I think the true Goldilocks is not going to be defined by output. It's going to be defined by the labor market. And we are going to see I think the unemployment rate stay quite low.
Laura, thank you. With FS Investments, Laura Rahn this morning there with a 1.4% call, slower economy here. Howard Marks, chairman of Oak Tree Capital Management, and I must point out, author of not one, two, but three important books on investing, of what to do, and just as importantly, Howard, what not to do. Howard, on Charlie Munger getting the odds on your side, How did Charlie Munger get the odds on his side?
He started off with a brilliant mind and a brilliant partner. He intensively studied the financials, thinking about the long term. He never tried to guess what a company or a stock would do in the short term, and he held for many years. He was a great practitioner of sit on your hands, and he did it flawlessly.
In the modern day and the modern media, I remember reading those annual reports, Howard, years ago. There was no financial media. There was no blogging internet, the short-termism we're living it now. What is the lesson of Charlie Munger's long-termism?
Well, if you want to hit the long ball, you have to be very patient. And, when the stock moves up the first 20%, you can't start taking profits. Charlie and Warren have held things for decades. And the other thing is and Charlie always talked about this, you have very few moonshots. Charlie said within the last year that most of his wealth came from 4 decisions. And what would have happened if he would have started trimming those 4 decisions early? He certainly would not have accomplished what he did. And I think Warren would say the same thing. Maybe the number 4 would be a little different with Warren. But, Warren's famous for having said, put all your eggs in one basket, and I watched the basket really closely. And I think that it wasn't one basket, but the idea of concentration and patience coupled with good decisions makes for a great success. A concentration and patience don't accomplish anything if you can't make above average investment decisions. But putting it all together is the formula for success.
Howard, you wrote in some of your thoughts about Charlie Munger that he had very definite opinions, in particular regarding the investment management industry. He viewed the industry with considerable skepticism, and while a member of it, I found myself in agreement with him more often than not. What exactly are you talking about in particular?
I think both Charlie and Warren felt that our industry, relatively few members of it, made substantial contributions to their clients' wealth. Many more members were well paid. He was always one who questioned incentives. He says, "You give me an incentive, I'll tell you the behavior." And I think that I think that Warren and Charlie viewed their operation. In fact, Warren said in quotes, "Not a partnership, not a corporation of partnership," and they considered the people they manage money for, their shareholders, to be their partners, and they considered themselves to be working for their partners and not themselves. And their own wealth and success was a byproduct of doing great work for the partners. So, I like to put myself in the same boat. Those sentiments appeal to me greatly, and I've tried to follow that.
How difficult has it been to adapt the strategy to different eras? When you had conversations with Charlie Munger, there were questions around tech and how that changed the investment thesis. How did they think about the changing concept of what a wonderful company looked like and what fair value was?
On the one hand, you have to evolve with the times. On the other hand, they never went full bore into the tech sector. They're famous for having made a lot of money with Apple, but most tech, the way they said it, they put it on the too hard pile. And if you understand that your success will come from a small number of holdings, that means you don't need 20, 30, 40, 50, 60. You don't need to exploit all the sectors. You just have to find a few great ones. Of course, on the other hand, Tom said that we're in a new era with all the communications we have. Part of what that means is that the world is a more interconnected, intelligent place. Back 50 years ago, we used to be able to exploit things nobody else knew. Today, there's very little information that doesn't make its way speedily around the world.
Howard, help us with one final question here to the management, the future management of Berkshire Hathaway. They have a from COVID buildup of cash of $412 billion out to $500 billion, $525 trillion. You and everybody else out there is living with explosive money market fund growth. You know the story in that. Forward here for Berkshire Hathaway, what's the best use of their and our mounds of cash?
You know, the people who run Berkshire today and will run it tomorrow understand the limitations of size. All things being equal, size makes it harder to outperform. They have the best probability of outperforming of any company their size, but their size will matter. And you know, one of my professors at University of Chicago, I asked him afterwards, how would you manage a big fund? He'd say, I would index the core and manage the hell out of the periphery. And I would imagine that at their size, they'll have to move in the direction of something like that, although they will not give up on outperformance.
Howard Marks, thank you, with Oak Tree Capital Management in remembrance of Charlie Munger.
I'm so pleased that we get to speak with David Rubenstein, co-founder and co-chair of Carlyle Group, host of peer-to-peer conversations on Bloomberg Television, because David is somebody who talks with all of the executives across Wall Street, Main Street, and beyond to understand how they're dealing with some of these transformative technologies of the moment. And David, I want to start there, kind of where the similarities are in how some of these executives are thinking about the developments in artificial intelligence in generative AI.
Well, everybody wants to be an expert on AI and figure out how it's going to affect their company positively or negatively. But honestly, nobody really knows for sure yet how it will work. We're really in inning one of artificial intelligence in terms of how major companies are going to use it or have it used against them. So everybody's trying to hire artificial experts or get people into their firm who can help them assess whether artificial intelligence is going to be useful to them or helpful to them. And nobody really knows yet. So I can't say anybody is certain how it's going to impact their business yet.
David, Mr. Zaffino steeled at Marsh McLennan and others, and then on he goes to AIG, where different than other executives, he has to deal with disaster. What did you learn about how he handles the unexpected?
Well, insurance is about dealing with the unexpected, really. And so AIG became the largest insurance company in the world for many, many years. And as a result of that, it had enormous tentacles throughout the entire financial complex. It clearly extended itself too much, didn't anticipate problems that arose, particularly in the mortgage area, and as a result had to be bailed out by the U.S. government to the tune of about $180 billion. Now that money's been paid back with interest, but AIG is no longer the biggest insurance company in the world and doesn't have quite the tentacles around the world that it once did, but still a very profitable company.
David, a newsmaker yesterday, this is what Rubenstein does. He's steering the thunder from journalists. David Rubenstein with Bill Ackman yesterday on the track that this nation will take. What did you learn from Mr. Ackman, David Rubenstein?
Well, Bill is a very impressive person who obviously is outspoken, has been outspoken on many issues over many years. Recently, he's become quite visible in what he's been saying about Harvard. But he said in the interview, which will air not too long from now, that he's made a new bet. He's made a number of macro bets that have turned out to be extremely positive. One of them, he made over 100 times his money on a bet that he made a number of years ago in the time of COVID. Now he's made a bet that interest rates will be cut sooner by the Fed than is otherwise expected. And if that bet is successful, I guess he'll make a fair amount of money. But that's the big issue that many people are grappling with. Will the Fed decide that it needs to lower interest rates before the political season starts, let's say in the summer or the fall of next year?
Excuse me. Go ahead, Lisa. Please. My fault.
David, is it surprising to you that a big hedge fund manager is focused on making big bets on treasuries right now?
Well, many hedge funds people are doing that, honestly. He has not done the so-called treasury trade that others have done, where he's buying treasuries and shorting treasury futures. He hasn't done that. This is basically a bet that the Fed will succumb to some pressure to lower interest rates before too long. Now, the conventional wisdom in Wall Street is that the Fed will lower interest rates at some point during the first or second quarter, more likely the second quarter. I think his bet is it'll probably do it sooner than the conventional wisdom. And I have said publicly before, and I still think it's the case, that the Fed will get in trouble if it lowers interest rates around the political season, because Republicans will say, well, you're helping Joe Biden by lowering interest rates if you do so over the summer or in the early fall. So if the Fed is going to lower interest rates, probably to avoid political criticism, it'll have to do it sooner than later.
David, you mentioned Mr. Ackman in Harvard in the horror of the Eastern Mediterranean. I want to go to your Duke University, where they have a bridge, folks. It's an old bridge called the Free Expression Bridge. And to make a long story short, they had to paint over a pro-Palestinian tone as well. David, I want you to talk to the great and good right now about how those of means and success should deal with their shock at our American universities.
Well, the American university system is still the envy of the world, and our private universities are really the places that people from all over the world want to attend. There's been a shock that many people didn't realize how strong the anti-Israel feeling has been in some campuses, and the result of that has been outraged by some alums. Some universities have handled this better than other universities. I'm the chairman of the board of the University of Chicago, and we have a tradition of not issuing statements on political matters or outside matters, and we haven't issued one in this case. But in many cases, other universities have not had that policy, and they've gotten in trouble for issuing statements that don't please one side or the other. It's a difficult way to walk this fine line, and I don't know that anybody has figured it out properly or correctly.
David, a glorious day for Bloomberg Surveillance with Doug Cass and Howard Marks with us in remembrance of Charlie Munger. Give us your thoughts on the hugely successful experiment that was Berkshire Hathaway.
For those who don't know, Charlie Munger was from Warren Buffett's hometown of Omaha. He moved to Los Angeles and later reconnected with Warren Buffett, who he hadn't really known before, but he had worked for Warren Buffett's grandfather at one point in a store. Charlie Munger was an outspoken, very, very smart lawyer who transitioned from being a lawyer to being an investor, and his track record early on was actually better than Warren Buffett's in some respects. They teamed up, became an incredible team of people who were mostly known to the public through their annual meetings, where Warren Buffett and Charlie Munger would answer questions for 6 hours on end. And Charlie Munger was quite well known for his, I would say, dismissive ideas of some other people's thoughts about investing. He was a very fundamentalist kind of investor, and he transformed Warren Buffett. Warren Buffett was taught to buy things very cheap, and buy things cheap, you can always make money. It was Charlie Munger's view that you should buy good companies. Maybe you pay a reasonable price for it, but buying good companies is better than buying cheap companies, which may not be that good. And Warren Buffett gives a lot of credit to Charlie Munger for having transformed his views on the investment world.
David, thank you for joining us today with this remembrance of Charlie Munger, and of course with your excellence. Look for a conversation with Peter Zaffino, peer-to-peer conversations, hugely anticipated in the next 10 days, a conversation with Bill Ackman that I would suggest move markets. Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern. On Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.